The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and that music means it's time once again for Volatility Views, your weekly source for all things volatility. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And if I sound a wee bit different this week, it's because I'm back from my long sojourn away from the studio, and I'm back in our main recording setup, so it's nice. I mean, I miss the Mai Tais in the pool, but it is nice to have our regular setup again and not to be dependent on the Wi-Fi of the resort where I was staying. So
all these difficult trade-offs.
Yes, life is nothing but a series of hard choices, Don. And whether to have a poor internet connection but fantastic scenery and fantastic beverages, or to record with a stable connection in our quiet and not exactly super exciting studio room. Those are the trade-offs we have to face each and every day. And of course, that voice comes from none other than good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the program, sir.
Thank you. Always a pleasure to be here. I'm looking forward to today's show. I think we're going to get a chance to answer some more of our listeners' questions, and that's always fun for me, and I think for you guys as well.
Yes, I love the guests we have on the show. I don't think anyone has even come close to putting together the array of guests that we've had on this show, particularly from a volatility perspective. It's just been fantastic to speak with all these people and hear their various viewpoints. But on the other hand, I do enjoy the occasional opportunity to really dive into the mailbag and give our listeners a chance to participate in the show as well. We did that a few weeks ago with to great acclaim, so we have an opportunity this week to do that again. So we will be diving into the mailbag shortly, but first we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of volatility and volatility trading action. And Don, I like what we did last week, where we started off in the land of NASDAQ, and there certainly has been some action in the land of NASDAQ this week. So perhaps we'll start there. Maybe even before we start, let me just fill our listeners in on our point of view right now, because, of course, we are recording at noon Central here in good old Chicago, 1 p.m. Eastern in Don's neck of the woods. And as we are recording, of course, the markets are selling off rather aggressively today. Most of the major indices are down about 2%. The VIX cash is up a comparatively paltry 6% given the action we're seeing in the broad markets, but a lot of broad sell-offs, a lot of red on the screen today due to the poor jobless claims numbers and a lot of other interesting economic data hitting the tape all at once. So a lot of interesting activity going on in the land of NASDAQ. Don, what has caught your eye since we spoke last?
Well, of course, it has been quite a volatile week and a volatile end to the month. And, we always do a kind of a follow-up to see how we did with our crystal ball. And this time it would appear that I got it wrong. I thought we might come in a little bit, but such was not the case. We have realized volatility in NASDAQ on the 1 month variety, last 21 trading days, up again about a half a dollar or so from the high 16s, almost 17 level to now, excuse me, 17.40, and even the 3-month edged a little bit higher as well. It had been just below 16 at 1588, now above 16 at 1602, and there is a NASDAQ VIX product now as well, which had been inching higher quite understandably as the market was selling off. We'll talk a little bit more about where this might be going for next week when we get to the crystal ball section, but it's certainly interesting to note that as we look at various trend lines, it still looks like there's more to the upside. And of course, today's action, everybody is listening to this on Monday afternoon, but Mark just mentioned that, the world is coming to an end today on Friday. So we've got a big sell-off, which will obviously add to the moving averages in terms of realized volatility as well.
So, Don, you didn't see the massive sell-off coming that we have going on today across the board. What is wrong with you, sir?
No, I'm sorry I missed it, but, it does point out something that we've said over and over and over again, and it is important that when people talk about VIX, when they talk about, fear gauge and implied volatility, you don't just see a whole lot of predicting in those terms. What you see is a whole lot of reacting. And we had VIX in the low 20s for earlier part of the week. They don't just suddenly spike up for no reason at all. This morning, the jobless numbers came out, unemployment, 9 o'clock, and obviously the options markets aren't open then. The S&P options upon which VIX is predicated weren't even trading yet. And the market sold off very sharply with the futures contracts even before the opening. And what happened later is, of course, the options do open. And when they do, you then have the kind of knee-jerk reaction that sends implied volatilities higher. And to me, this cause and effect continues to be that the market sells off, and then we see the kind of dutiful rise in VIX. You mentioned something earlier, though, and I don't want to steal Mark Sebastian's thunder, but it is interesting to note that we have sort of offsetting forces. Very often on the Friday, we get this weekend effect from everything kind of selling off into the close with implied volatilities that sends VIX a little bit lower on Friday afternoons. But of course, with this tremendous sell-off, we do have an increasing VIX, but nowhere near the kind of levels that you would expect. The S&P is down 2% as we speak, and normally speaking, to the downside, you might have a multiple as high as 6 to 1 or 8 to 1. You could have expected, if this had happened during the middle of the week, to see VIX move higher by as much as 6 to 8 times 2% or 16%. And, if we started at somewhere in the 24 range, you very well might have seen, a 3-4 point move in VIX, but you're not seeing it right now. You're seeing only about a 1.25 point move. And I think that's that fight between wanting to go higher, but having the weekend effect sort of tugging in the opposite direction.
Ah, yes, the good old weekend sell-off. Those market makers, they like to sell their premium before the weekends.
But the interesting thing is we've been seeing that effect kind of weakened by, the weekend risk. I've noted that the last 3 weeks, the latter half of the day, vol has rallied significantly into the close as traders make the smart decision not to go crazy short premium over these long weekends. That's part of the reason why we saw VIX rallying into a 3-day weekend last Friday and rallying the day before. Now, today we're seeing a little bit of weakening effect because there's really not a lot of news that could come out. But we definitely have a situation where that weekend effect is kind of briefly changed as people are really afraid of what could happen in Europe over a weekend.
And listeners, you keen-eared listeners have certainly deduced that we have been joined by none other than Mark Sebastian from OptionPit.com. And Mr. Sebastian, as Don and I were just pontificating about the weekend effect, you don't think that is the case. So why do you think that the VIX is a comparative shrug today, given what we're seeing in the broad indexes?
No, I know. Today it is a little weekend effect. But let's not forget, we got the VIX we had terrible news today, right? Everything stinks. We got the market off, 2%? Which puts the VIX at around 30. In order to keep a VIX higher than 26, which is an elevated VIX, you need 2% moves a day. And I don't think anybody thinks that if you look at the way this sell-off has happened, it's taken us a month to move 100 points. Down, we talked about this last week, down slowly in one direction does not mean the VIX should be at 50. So I think if you want to see the VIX pop, watch the S&Ps move another 10 points this afternoon and tell me what happens to the VIX then. Things could start to get really interesting. But you're right, you are seeing some VIX weekend effect this weekend. We have not seen it a couple other weekends. And Mark, I'll be interested to see if we get down 30. One of the things you were talking about from the SIBO risk management, I'll be interested to see whether some gamma scalping starts affecting S&P movement.
Yes, you're right. We did see a lot of interesting developments coming out of that risk management conference, particularly when it comes to that short gamma and all that scalping, or I shouldn't really say scalping, is hedging, when you have that short gamma towards the end of the day. And the panic movements and the massive leaps we've been seeing in a lot of the broad indexes toward the end of the day have been recently attributed to that short gamma effect. So it will be interesting to watch today as we're moving, if we start to see some of those short gamma players kick in again today towards the end of the day and move this thing 10 handles in either direction. It would be interesting to watch that, because I agree that is a lot of what's been moving us towards the end of the days are these short short gamma players coming in and having to hedge towards the end of the day. And and like I said, that still kind of gets into the realm of the unknown for all of these ancillary products that have sprung up around the S&P and around the VIX that have created this feedback effect that I don't think anyone really has fully mapped out yet and understands fully the impact on the VIX's, on the vol of VIX and the term structure of VIX, and indeed on the hedging developments that occur towards the end of the day. So there's still a lot of interesting work to be done, I think, analyzing and looking at all that stuff and how they all feed back. And it's an ongoing process, because every time we do this show, there's some new VIX ETP floating out around there, or some development with them. So it's an ongoing thing. I don't think a lot of our academic friends we've had on the show like to tackle such a moving target like that. They like nice static things that you can easily test with some back tests and some time series.
Two things our academic likes is static data and English accents.
We certainly have had our series of those over the lifespan, shall we say, of volatility views. But Mark, anything else catch your eye in this week's worth of VIX action before we wrap up the old volatility review?
We're breaking new highs right now, and I think we've got a nice move up to 30. So, I do think that is coming. It's not going to take much more, another day or two, and I think we're there.
All right, save your powder then for the crystal ball, sir. Keep our listeners in suspense. That will be your tease.
You guys have no idea what I'm about to say in the crystal ball.
Stay tuned to see if Mark completely does a 180 over the next 40 minutes.
And I may.
You never know with him. He's fickle that way. All right. And that's going to do it for our volatility review. And now we're going to dive right into an extended listener mail segment.
Listener mail. Listener mail. Listeners write in.
Mailed in.
Mailbox.
All right, and welcome to the listener mailbag. This is, of course, the portion of the show where you guys get to chime in for a change. And we have another interesting series of questions coming via email and Twitter and Facebook and all sorts of methods for you guys to get at us here on the show. And we're going to kick things off with a Twitter question from Damien14. a very timely Twitter question given everything we've been seeing over the past few weeks. And he writes, how do you guys feel the addition of Facebook will impact NASDAQ volatility in the future? And Don, since you've been pontificating about NASDAQ vol for quite a while here on the show, I'll let you run with this one first.
Well, it's a difficult analysis only because you take an index that's comprised of 100 names in one case, or the NASDAQ 100 or the overall index, and you throw another name into it. And that particular stock has a certain volatility. And of course, everyone's trying to get a handle on what that volatility might be because you have only a small amount of data. Is it going to behave like a 60 vol stock or more like Google? Is it going to be a 30 or 40 vol stock? The jury obviously is still out, and the early action from the result of the IPO isn't really going to settle down and tell you the whole story for quite a while. But the part that makes it very difficult to answer, and we get a little bit mathematical for a while, and then I'll turn it over to Mark and let him talk about the practical aspects of Facebook and the options and how it's going to trade. So one of the interesting things about when you add a stock to a portfolio is it isn't at all straightforward as to what the effect on the overall volatility of the portfolio will be. For example, to take the simplest kind of case, just to get a feeling for it, supposing your portfolio was but a single stock that had a 40% volatility. And I come along and I say, well, now I'm going to add another stock to the portfolio, and that also has a 40% volatility. What's going to happen now to the volatility of the two-stock portfolio? And the correct answer is I have no way to answer that question unless you give me some more information. And the reason is because you have to know how the two stocks are going to correlate. For example, in an extreme case that wouldn't take place in the real world, but just to make the mathematical example, suppose the stock that you added was 100% negatively correlated to the other one that was already there. Suppose that every time the first stock went up $1, the new stock went down $1, and did that all the time. Well, what would the volatility of the new portfolio be? It would be zero, because the portfolio would never move. Every day, one stock would do its thing to one direction, while the other would show its volatility the other direction, and they would net to zero, and you'd have no volatility whatsoever. Or rather, you'd have a volatility, but it would be zero. And so when you say I'm going to add a stock to a portfolio, you have to consider the interaction of that stock pairwise and what we call covariance with all the other stocks in the portfolio, and that can become a more difficult mathematical analysis. So it's a rather long answer to say I'm not sure we can answer that question right now, not only because we're not sure what the volatility of Facebook will be, but also because we don't yet know what its correlation will be to the other members of the portfolio.
Well, and I would say that in terms of the real interesting thing is we don't even know what Facebook's weighting is going to be. Right now, Facebook would be the 7th or 8th largest company in the NASDAQ 100. It's bigger than Amgen, smaller than Google.
Unless it continues on this slide, then we'll see.
Right. Let's just say that it ends up being the 8th biggest. What, Don? What's the kind of percentage down there? 3% or something like that?
Yeah, I think that when you get to the top 10, now you're at 2-3%.
Yeah. So here's basically what you're doing. All right, all of the other companies that are that big, and Don, here's why I think vol is going to go up. All of the companies that are that big have a vol that is on average below 30, probably in the around 20 to 25. Google and Apple recently has been closer to 30, but really normally is around 25. Google around 28. Microsoft is in the teens. Intel is in the teens. You're adding a huge company to the list that will have a realized, I mean, certainly from a VXN standpoint, VXN's average price will go up because you've got Facebook that will have a implied volatility once it settles around 35, maybe 40, and it's a 3% of the index. And with the way it's been moving around, that big of the index with that big of realized volatility, you will see realized vol tick up whether you like it or not. Because my guess is it's going to be taking away. It's really most of the vol of those indexes of that index comes from the top 10 or 15 components. So adding a big hitter with that much volatility is certainly in the near term and likely in the long term going to cause both realized and certainly implied to tick up. And I just mathed your math.
Well, here's
Checkmate.
the thing, Mark. I wouldn't disagree with you, on any kind of general principles. I would just simply say that normally speaking, stocks have some kind of positive correlation to each other in that they're all equity. And so long as that's the case, and so long as you add a name that's more volatile than the others, then everything that you're saying makes perfectly good sense. Every once in a while, though, you might get stocks either because of the industry that they're in or for whatever reason, actually pick one stock with another that has some sort of negative correlation or that tends to be, an anti kind of indicator that moves in the opposite direction. And so in the event that you have any reason to believe that Facebook may actually correlate negatively to any of the components, that's the only thing that could make the prediction more difficult. But if you see no reason for that to be the case, then surely I would agree with you.
I don't see Facebook coming in as the big negatively correlated name in NASDAQ, particularly with so many other tech-heavy names in NASDAQ like Apple. I think the subtext of this guy's question really was, is Facebook going to be the next Apple, which essentially almost becomes an index unto itself?
No.
And I think the answer to that is resounding no, given the activity we've seen of late. And speaking of activity, we have another timely question, an email question coming in from Tim L. out of Portland, Oregon. And he asks, what's your opinion of Facebook's option vol and option trading so far? It's a very broad question. Fortunately for us, we actually have some interesting data on this. If you check out the optionsinsider.com and click on our Facebook flow recap and pre-listing survey results article there, we partnered with our friends over at the Street and Trade Alert to take some of your bellwethers of what you thought Facebook was going to open at and what kind of volume it was going to do, and compared it to what we actually saw on that first day. And on that first day of trading, we actually saw Facebook put up about 365,000 contracts, so a ton of contracts, but not exactly surprising given the heat and the interest on this one. And we saw actually one person did win the survey with a number that came in relatively close to that. And also quite a few of you actually predicted call volume with about 176,000 and put volume about 207,000. So we have some pretty savvy listeners out there who people actually were very close in the ballpark. In terms of front month ATM vol, you guys were a little bit more, I think, dour than we were. I can't remember if it was on this show or on Option Block where we kind of predicted ATM front month vol probably starting off around somewhere in the 60 to 70 range. And that pretty much is where it actually opened, about 66 right off the bat. So that we were pretty much on the mark there. The surveys here, the survey takers predicted in the 30 to 40% range, which actually surprised me. I thought they would be leaning higher. I thought they would probably lean to some extraordinary degree, 70, 80, 90, 100% vol. But they were actually leaning in the lower vol range. And so they were actually underbidding Facebook vol. I guess good thing they weren't market makers. They would have been selling a lot of contracts on the open there. And that's some of the interesting data we saw coming out of Facebook on that opening day and on our opening survey. Of course, since then, Facebook actually has been putting up some serious numbers, averaging about 300,000 contracts a day. So this is no shrinking blinking violet by any means. A lot of that is due to the fact that it's been selling off aggressively almost every day since it's been listed. In fact, as we're recording right now, it's trading about 27 in the orders or so down about 6% again today. So this name 10 handles south of the IPO price or so, and so just a aggressive sell-off. And today it's doing about 120,000 contracts today, with the bulk of that being a very bearish bias. We also saw a bearish bias on the opening day in terms of volume. Not exactly surprising, given how much interest we see in these puts and things like that going into these names that everyone wants to short and simply can't short when they list on the first day of options trading. Mark or Don, anything else you guys want to add to what we've seen so far from Facebook option vol and or option trading?
No, I'd just say very briefly that I think the high tick was 45 or so, and if that's the case, then 27 now actually represents a 40% drop from the poor people who bought the high tick. But,
Sebastian, wasn't that your print there for the kids' college fund?
Yeah, I said 40. Buy them all.
But of course,
I mean, and you could make this. This argument was an easy argument. Facebook had no business being 70% of the value of Google. All right, just didn't make any sense. And anybody who bought in got and Mark and I warned everybody ahead of time. Stay away. Don't be a dummy. And anybody who walked in and said, oh, I want to go and buy this, you're welcome. You got exactly what you deserved.
But I think the only other point that I want to add is that when you try to extrapolate any kind of predictions for either realized volatility or options volume or anything like that, as everybody knows, I'm not making a subtle point here, but a rather obvious one. You got a stock that just moved 40%, since it came out 2 weeks ago, and basically the options just this week. So you've got tremendous interest, you've got tremendous movement that's not likely to sustain in the weeks and months ahead. So we've seen the action. We know what we can measure now, but you have to be careful in extrapolating that out too far, because stocks just don't continue to move like this for months and months and months, and both the options volume and the volatility of the stock itself will obviously contract somewhat as we go along.
Whoever came out with that massive program sale across all of the Web 2.0 names the day of the IPO certainly seems like a genius now.
It was brilliant. Oh my gosh, brilliant move.
That guy took a lot of money off the table and is quite happy that he did so, I'm sure, given what we've seen in the last couple of weeks. All right, and moving on to another Twitter question here. This one looks like it's for you, Don. This is a Twitter question from Euro DJ. Apparently, he's a European DJ who also likes realized volatility. He writes, any update on the NASDAQ vol contracts, guy? So, Don, I will leave that in your capable hands, sir.
Well, there isn't a week that goes by that we're not meeting with someone, whether it's exchange officials or options exchange officials or potential market makers and order flow providers. So the news is certainly that we are moving forward. I wish I had a hard and firm date to say, here's when we're going to begin trading them. I don't have that date yet, and we'll obviously keep everyone apprised as we go along, but we continue to make progress in bringing these to the marketplace.
All right, slow but steady wins the race, says Don, on the vol contracts from NASDAQ. We certainly get a lot of questions on that topic, so stay tuned for more information on those products as it develops. Next up, we have a Facebook question from Steve K. out of Victoria, British Columbia, our good old friends up in the true north.
Boo! No more Facebook. Boo!
Yeah, he's probably not too happy. Hopefully he's just a user and not a shareholder. He writes, is delta neutral hedging the only way to trade realized volatility in the options market right now? And in parentheses, outside of vol contracts on the euro, of course. I like what you guys talk about every week, and I'm looking for ways to capture that good old realized volatility. So, Steve K., thank you for listening to the show. Sounds like you've been listening for a while. And yes, we talked about this quite a few times, particularly in our early episodes about delta neutral and the pluses and minuses thereof, how that is pretty much the main way. If you don't want to use something like a vol contract on the euro, or you're not a euro trader, for example, that's still the main way most people go out from an options perspective and try to capture quote-unquote pure realized vol. We've discussed in the past why that isn't really pure realized vol and all of the issues that are attendant with delta neutral trading, like having to hedge and maintain your hedge on a regular basis, a lot of commission costs, a lot of slippage errors prone to that. But if that is the way you want to trade, I don't know, you don't mention what underlying you're looking to trade. I'm assuming it's not the euro, because you're saying you don't want to trade the vol contracts on the euro. So I'm assuming maybe you're talking S&P. If it's broad indexes, then maybe you have a few more options. But if it's a general listed equity option, then delta neutral is the primary way that you really can capture your quote-unquote realized vol right now, even though it isn't the perhaps the ideal way going forward. There has been talk about some more vol products on some of these listed names, and maybe there are some interesting structured products out there that try to replicate this. I'm not aware of any on some individual names off the top of my head. Mark and Don, are you guys aware of any other ways aside from good old delta neutral that people are, I mean, real legitimate ways, not some product that trades 3 contracts a week kind of thing, that can capture realized vol for good old Steve K here?
You have to go over the counter. There's nothing other than the vol contract and over the counter stuff.
I'm guessing Steve K is perhaps not size up enough to pick up the phone to Goldman Sachs and say, can you please structure me a realized vol product?
Yeah,
but
no.
yes, long story short, Steve K, yeah, unless you want to trade those vol contracts on the euro, you pretty much have to go delta neutral, and I recommend you listen to our earlier episodes, probably episode 1 through 5 or so, where we talk quite a bit about delta neutral and the upsides and downsides therein. All right, next up,
off 30. Are you aware that we're off 30 now?
That we're what?
We're now off 30 handles.
Oh, you're right. As Mark is saying that, as we are recording this, we have dropped, about 30 handles in the S&P right now. So we're down about 2.3% in the S&P, 2.6% in the NASDAQ, and exactly 2% in the old Dow. The VIX cash ticking up about 8.2% right now to 26, roughly 26 even. This gets to what we were talking about earlier, where if there isn't a dramatic move towards the end of the day, we might see VIX pop. So we'll have to stay tuned to see if this continues throughout the end of the show into the end of the day. Next up, we have an email from Dick Framingham. It's a great name, in Rochester, New York. And he writes in without really, not too much of a question, more of just a love fest for the old show. He writes, I just wanted to write in to let you guys know that I love this show. Volatility Views is unique in the options podcast world. No one else is out there talking about the stuff you guys talk about or bringing on the guests you guys get. It truly is a fantastic, one-of-a-kind program. So thanks again for putting together such a great show. And Mark, thanks also for the Options Insider Radio Network. He writes at the end here, you truly are the voice of options. He must have been, he's referring to a name our listener referred to me on, I believe it might have been Option Block quite a while ago.
If you're the voice of options, then you know what? Never mind.
You don't want to go down that road, sir.
I was about to say something really mean.
You're going to a very dark place, and then you don't want to go there. But yes, well, thank you for that love fest there, Dick from Rochester, New York, and we'll try to continue making you happy on this show for a long time. A long time to come. No matter what form or shape Vol Views takes, we will continue to try to bring you that weekly dose of volatility love. And next up, we have a Facebook question from Tim Bond in Tulsa, Oklahoma, of the Oklahoma branch of the Bonds. Perhaps he is James's cousin. And he writes in, another one pulling up the voice of options. We got Mark. He writes, Mark, quote, voice of options Longo. Don, quote, sold to you Schlesinger, and Mark, quote, Tinny Sebastian.
What the heck?
I like this guy already.
How is that fair? All right.
He writes, I have a pressing question that requires your vast expertise. I think you're going to like him better when you hear his question, Mr. Tinny Seabass. He writes, why in the name of God does the VIX have a skew? Shouldn't that information already be represented in the SPX options, or am I completely missing the boat on this? Thanks again, and I love the network. That new Options Bootcamp show is fantastic. Well, thank you, Mr. Tim Bond. And since you slighted Mr. Sebas so heavily, I'll give him the first crack at this. Actually, I know this is a topic you and I have discussed many times, probably off the show in the past, but I know this is one that is near and dear to your heart, the topic of VIX skew and why in God's name it exists. So perhaps we should, I'll let you start there, sir.
I agree. I don't think that VIX has a great reason. The VIX skew has a great reason, other than supply and demand is the major thing you have to be aware of. So the fact of the matter is, it's same reason SPX has a skew. More people want to buy upside calls to protect themselves than people that want to sell put. And people are paying for that by selling puts. I mean, that's really the story there, and that's really what's driving everything. So the answer is simple: supply and demand. Do I think that theoretically there's a good reason for it? I don't think there's a great reason for it, and that's just it's there for supply and demand reasons. So I kind of agree with them. Now, I will say this though: the SPX skew has, the two of them are allegedly interrelated. I don't want you to think that because SPX has a skew, VIX shouldn't. And in fact, the SPX having a skew means the VIX should have that forward skew, because it points towards supply and demand being in the same direction. Because remember, SPX downside equates to VIX upside. So that is why.
Yeah, it is very much just a mirror image reflection of what we're seeing in the old SPX land. People love those puts, so they love those upside calls, and we're seeing that same reflection in VIX. I think part of it also is just that reflexive love. Options traders these days need to have a skew. We're trained on it. We love it. That's how we trade options. So it exists, whether or not you want it or whether or not you think it should be there. It exists in all of these products. And yeah, the S&P product is just like we said, just an image, just a reflection of what we see going on in the land of S&P from an option skew perspective. People bid up those puts, they bid up those calls correspondingly. And of course, since the two are related, there's hedging activity between the two and vice versa. So there's a lot of trading back and forth that keeps those two at similar levels. Next up on the old mailbag, we have a Twitter question. This is not now, Mark, this is not a question about Twitter. This is a question from Twitter, just so you don't lose your cool there. We have a Twitter question from another good handle, Axeman74. He writes,
I would love a question about Twitter.
Too bad there's nothing really to talk about there from an options perspective.
I love tweeting.
But yes, Axeman74 writes, why do you think so many attempts to bring OTC vol to the exchanges have failed? And he gives CBOE variance contracts as an example. Well, in the example you cite, there's a very specific reason, which is that those OTC variance contracts are very nuanced. They're very large. We talked about them on the show in the past. Their strike prices are very difficult to calculate, and the manner that the CBOE used to construct their contracts really wasn't in line with what the OTC market expects. So they really didn't flock to them. That's kind of the specific reason for that specific product not really doing that well. CBOE has announced that they are in the process of revamping that contract to try to bring it closer and more in line with what the OTC variance traders expect, and so we'll see if that is enough to bring them to the exchange. I'm guessing, given the broad history of what we've seen of OTC products when they try to migrate them to the exchange, is probably going to be a resounding meh, I should say. Really, the history of OTC products on the exchanges hasn't been very good, predominantly because that OTC cabal doesn't want to give up its volume without a fight, and the number of firms in that cabal has lessened after the 08, 09 meltdown and all those firms that blew out and went away. But still, those firms, I mean, think about it from their perspective. If you're one of the handful of market makers in a product, why would you really want to cede control of that, bring in more market makers, tighten up those markets, and lose your dominance of that product? You have almost pure pricing power when you're in that OTC realm versus a listed, broadly traded product that has a lot of people coming in, a lot of chefs in the kitchen spoiling that that setup for those OTC firms. So they have a vested interest in keeping those products on OTC as long as they can. Not to say there isn't a relationship between the two. A lot of volume in a OTC product will often result in volume in some sort of correlated listed product as a hedge and vice versa. So the exchanges aren't super unhappy that there's a lot of volume on OTC in some of these products, because it does drive volume in some of their listed products, OTC vol products and VIX being a good example of that. But in general, if they had their way, they would love to bring all those products to the exchanges because it just generates more transaction fees. And so far, the OTC cabal has done a good job of resisting those efforts. Mark, Don, anything you'd like to add on those in terms of OTC products failing or OTC vol products failing on the exchanges?
Well, of course, the key here when you say OTC vol, we need to distinguish between variance and volatility, and we need to distinguish between implied and realized. So, of course, the one piece of the puzzle that we hope to bring to the marketplace will be realized volatility products to the listed exchanges, and that's not variance and that's not implied volatility. But as many listeners know, when you do a volatility swap or even a variance swap over the counter, it settles to realized volatility. So concept of bringing realized volatility onto the exchange is not something that has actually failed. It's just something that's not been done yet, and exactly what we're hoping to do in the very foreseeable future.
Yes, when you get into the realized realm, it is an entirely different question. So we'll have to wait and see when those NASDAQ products launch, how well those fare in luring some of those OTC customers onto the exchanges. And last up here in the old mailbag, we have a pretty fun question via email from Joe, I believe that's Eftes, E-F-T-E-S, Eftes, writing out of Sacramento, California. And he writes, I know you guys have talked about selling vol when others are buying, like when a newsletter recommends buying a particular put, for example. That's a very favorite tactic that I know Mark and I have discussed on many shows, including the option block. Sell when the lemurs are jumping in to buy. But he goes on. How exactly do I execute that trade? Do I wait until late in the day when everyone is done buying, then sell that same option? Can I sell nearby strikes instead? What about the stock? Do I have to hedge delta neutral or 1-to-1 to really capture the vol premium? I am really interested in this strategy, but a little fuzzy on the actual execution. Well, Joe, this is a great question. We have talked about this quite a bit on the option block, actually. But since you're talking about vol, it's a good topic to bring up on this show as well. And the answer to your question is there are numerous ways that you could do this. We typically recommend spreads. You can. The probably least ideal way to do it is to, like you say, wait until the end of the day when all the action is done and then sell that same contract. You can do that, but typically we recommend maybe selling strikes that are nearby and then spreading them off. Because as you notice, these strikes get bid up. It's not just that one strike. The nearby strikes will have a resulting increase in implied vol as well. So you could trade them. You could trade them and capture that implied vol premium a number of different ways.
Well, that's the one thing is that picking up vol is kind of like picking up like a napkin off the ground, where somebody really slams a strike or buys a strike. Yeah, that one strike moves. But imagine grabbing like a cloth or a napkin and pulling up. Everything around it's going to move. So the key is to find, if you really want to spread, find the strike that's kind of the least bid or relatively cheapest, and then sell what's relatively expensive against it. You actually, I don't suggest for the retail trader to go in and buy something and hope that it keeps going. What I'd be looking to do is actually sell and then wait to buy, not the other way around, if that makes sense. But yeah, the key is there you do want to create spreads when you see volume like that, because usually when there's volume like that, there's a reason for it. And yeah, this is something we talk about on Option Block all the time.
Yes, that was we've always talked about when we were back on Market Makers. Those are some of our favorite trades when a particular newsletter would light up one strike, let's say in the S&P for some reason. Someone says buy the S&P 800 puts. So like lemmings, they all charge in and buy those 800 puts, 1 lots, 5 lots, 10 lots,
Exactly.
20 lots all day long. Bid that strike up out of control. It gives you a lot of ways to trade that spread against it. If you are relatively savvy and want to capture that pure vol premium, then by all means you can do it delta neutral. We've talked about that on the show many times in the past. That will give you that quote-unquote pure vol position, but we also recommend just doing spreads, nearby strikes against other strikes, and we've talked about that too. Delta neutral is a dodgy bet for a lot of retail who don't really have the facility to hedge aggressively and have the account size to do it. So I think probably you'd be better off just executing option spreads. And but Mark is right. Don't race to buy and try to catch that falling knife. That's a dangerous right. strategy for a number of reasons that we've outlined on this show in the past. The difficulties of being long premium for a retail trader. All right. Thank you everyone who wrote in today. And if we didn't have a chance to get to your question, don't worry, we'll get to them on a future program. But now we have to move on to the old crystal ball segment.
And now we take a look at the crystal ball.
All right, and that somewhat haunting music means it's time once again for the old crystal ball segment. And Mr. Sebastian, since you completely spoiled your crystal ball pick in the vol review, I'll let you go first. What possibly could you have to say, sir?
I think we're going to see 30 here shortly in VIX. You don't get to. Don, you were a bond guy for a long time, right? Did you?
No, not at all.
Nah, well, Don, you were never a bond guy, right?
No, I was never a bond guy.
All right, well, I take it from a bond guy like me. That's a joke. You don't get Treasury futures and the 10-year note and the 30-year bond are at absolute.
We hit all-time lows today.
Panic levels, right? The prices are at all-time highs. The yields are at all-time lows. All right, that's a very important thing people understand is that it's yields that are all-time low. And if you consider VIX and kind of the bonds are similar insurance products and they're similar fear-based products, the chances of the VIX not catching another leg up are relatively low here. I think you've got something really ugly here. So I think 30 and 35 may have their highs, and 40 might be tough, but you don't know.
Yeah, given all the love we're seeing for these bonds these days, that certainly wouldn't be too outside the realm of reason.
I mean, the bond stuff is just scary.
I mean, these all-time lows. We're not misstating that. This is a all-time low here for, I believe, the 10-year and the 30-year as well. Correct?
Yep.
So yeah, crazy levels in the bond land. So certainly something that to pay attention to. We obviously talk about options and volatility primarily on this program, but we are not immune to the vagaries of other products. And Mr. Sebastian, a diehard, inveterate bond man like him, when he brings up bonds, you certainly need to pay attention. And next up, or should I say last up on the old crystal ball, none other than Don Sold to You, Schlesinger, as our reader pointed out in the mailbag. Mr. Sold to You, what do you foresee for the coming week from a NASDAQ vol perspective?
I think I'm going to have to be chasing here. It's not good to be always one step behind, but I really, at this point and looking what's happening this afternoon, even in the hour that the show has progressed, I can't see any reason, just as Mark has forecasted as high as 30 on the VIX, to talk about volatility dropping or slackening off in the foreseeable future. This is some pretty ugly action, and I'm afraid it's likely to get worse before it gets better, which simply means more volatility as well. In the time that we talked about that low ratio of VIX movement to S&P movement at the top of the show, we now have almost like a 4-to-1 ratio. Still not as dramatic as 6 or 8-to-1, but at least more in line with what you would expect, even as you might fight the possibility of any kind of a weekend effect. So this is a pretty dramatic day. S&P is within less than 2% of where it started the year. So practically all the gains that we had during the first quarter and early into April have been erased by this miserable May and this first day of June. So nothing to be very happy about at the moment.
Nope, unless you're long some vol here, then perhaps you will have a smile on your face going into this weekend. Of course, we'll see how this plays out coming into the final few hours here. If this progression continues, and if we keep selling off as we close out the show here, we are down about almost exactly 30 handles in the S&P. So we'll see where we go from there. Listeners, you, of course, on Monday will already know, but for us, it remains a mystery. And with that mystery intact, we will close out the Crystal Ball segment as well as this episode of Volatility Views. And before we go, Mr. Sebastian, why don't you fill our listeners in on what is coming up in the land of OptionPit.com?
I am going to be doing a webinar for TheStreet.com next Wednesday in New York. And then it's going to be on volatility and directional trading. And then the following week, we're doing the third in our series of weekly options at Option Pit. Although I'm going to have to eventually rewrite it since the SIBO is avoiding it, since the SIBO is kind of changing weeklies.
Changing the game, finally. About time.
Yeah.
So let me just guess that your third series is just called Weeklies. Buy 'em. Is that yes, what it's called?
That's exactly right. Weeklies, buy
'em. Nothing but buying weekly premium for Mr. Sebastian over at Option Pit. And Don, what is coming up in the land of Volex.us that may interest our listening audience?
It's been a pretty quiet week. I spoke about the library last week. I'd like to re-emphasize that for those of you who are doing any kind of research and who perhaps are scholars of volatility studies, it's really a terrific place to go to find a tremendous assortment and collection of studies of all natures, not all academic, many magazine articles and practical online articles that have appeared in recent years, both on realized as well as on implied volatility. So, we'd like to be the website that pretends to be all things volatility. And I think if you haven't had a look around, you'll be pleased with the amount of information that can be found there.
All right, thank you for that, Don. And if you'd like to learn more about any of the topics we discussed on the program today, or if you'd like to follow in the footsteps of some of our listeners who wrote in today, or if you'd like to just follow in their footsteps and listen to some of the programs they mentioned, like the Option Block or like Options Bootcamp, then by all means, surf on over to theoptionsinsider.com. You can find all of the episodes of this program as well as every other program on the old Options Insider Radio Network, as well as breaking news from the options market. We hit the nail on the head. We knocked it out of the park with our rumor mill article last week about Peak 6 acquiring Penson. People thought we were crazy, and then it turned out to be dramatically true. That news came out today, of course. So getting some nice fun scoops from time to time over there at the Options Insider. So if you want to stay tuned to that stuff, then by all means, surf on over to theoptionsinsider.com, or of course, search for us on iTunes. Just type in Options Insider or Options Insider Radio. You can find all of our programs there, as well as Stitcher and pretty much everywhere else that you can find fine audio programs. So before we close out, we of course would like to thank all of you out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you all next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your your question in the Volatility Views Forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.